Obviously, everyone wants to be rich now when they're younger. The most obvious thing to do is increase your income through like a side hustle, whatever it is, then how much more you could invest. And that whole, like, I don't want to be rich from 65 mindset, I would much rather be wealthy when I'm older through investing today than still being in my 50s and 60s, having to work a 9-to-5 job, commuting on the train, struggling to get by, living paycheck to paycheck.
Do you find yourself winging your way through life, hoping you'll figure it all out on the way? Hello, it's me, Gaby Mendes, your 20s wing woman, and you're listening to the Talk Twenties podcast. Here you'll find me chatting to influential 20-somethings on different topics that matter to you in your 20s and all the things we never got taught in school. This is your ultimate guide to adult life. So if you're ready, let's go. Hello and welcome to a brand new episode of the Talk Twenties podcast. Today I'm joined in the studio by Ryan from Making Money Simple. Ryan's platform is incredible. It talks all about investing, crypto, saving, everything that you need to know about money. And it's so important to learn about this stuff in your 20s. So hello, Ryan. Thank you for coming up to the studio.
Hello, Gaby. Very glad
so
to be
nice
here.
to have you here today. Thank you for coming up to Liverpool. You're from London originally, aren't you?
London, yeah. Came up last night on the train. I've got a bit of a cold for anyone listening, which is why my voice is a bit croaky. But no, I'm glad to be here. Talk about investing. Thank you for the intro. I appreciate it.
Yeah, I'm really excited to talk about investing. We actually did a episode on this about a year ago with your friend Timmy from who's called Mr. Money Jar on Instagram as well. And in that episode, we kind of cover like an introduction to investing. So, you know, for anyone who doesn't really know what investing is, why they might start thinking about it. And that's a really good episode to listen to as like a basic intro to investing. But I think we're going to go a little bit deeper into investing today, talk a little bit more about the how you do it as well. And like, so the why, the how, and what you really need to know before you get started. Tell us a little bit more about why this passion came about to talk about money online, but specifically you're quite heavily focused on investing, aren't you?
Yeah, so I was in my final year of uni and I'd worked for a year in London before, done like a year in industry as part of my degree. And I sort of realised during that year that I didn't really want to work in London for the next 40 years for my entire life. And I sort of started reading about like side hustles, passive income, investing. And it was really, my sort of second semester, final year of uni, when I sort of started Making Money Simple. I was also studying economics, so I sort of liked talking about money. I was reading about investing. And then I guess, I don't think it was like one sort of like thing, but sort of over time, slowly, I was just like, I need to have a side hustle. I need to start, I guess, trying to monetize that. I'm interested in investing, and then Making Money Simple came about in sort of like February 2019. And that was like 2.5 years ago. And now we're here doing a podcast.
Yeah, I know. It's amazing. You have your own podcast, don't you, as well, where you talk about it, your own YouTube channel as well. Yeah. So, you know, there's lots of content out there that you put out there, which is all part of like what you've been doing to kind of grow and monetize your side hustle as well. But, you know, it's fantastic, the platform that you've got. We're going to go into talking a little bit more about investing, how you do it. But before we get started, we're going to talk a little bit about our sponsors, Zadosh.
Yes.
They've sponsored a few of our episodes beforehand, and usually it's me just chatting about them, but I know that you're a big fan of them as well.
Yeah.
So I thought we'd chat a little bit more about Zadosh, what you can do with the app, because it basically pays you to watch ads, doesn't it?
I was literally doing it yesterday. So I also worked with them recently.
Yeah.
So it's good timing. I was literally doing it yesterday. You go on the app, you watch some ads, you get some cash, and you can literally cash it out. And 5 seconds later, it's in your bank account.
I know, it's crazy. Like you can literally, I mean, I was like, I mentioned before, I was stood at the post office and I was just watching the queue because I'd usually just be scrolling on Instagram, watching TikToks or whatever. And by the time I got to the front of you, I'd made the money to post my letter. It was crazy. It's so good. Like you're literally just there, and the ads aren't boring either.
They're like tailored to you.
They're tailored to you, exactly. So like when you like sign up to the app, you have to like register your like your bank account.
Yeah, and actually I got quite a few questions. People were skeptical about that.
Yeah.
Like that open banking, a lot of budgeting apps, a lot of apps, like financial apps these days, it's open banking. You link your bank account and then essentially, I guess like it knows who you are better. So in Zadosh's case, it gives you ads that are tailored to what you actually like.
Exactly. Why were people skeptical about like the open banking side of things?
I think people generally just like skeptical when you have to like link your bank. But I was sort of saying, well, like a lot of budgeting apps, you have to do that.
Yeah.
Like a lot of companies can have your sort of open banking bank details anyway, so it's nothing
but
new.
they don't actually know it's you. Like this is all done by like user ID or anything like that. Like they don't actually know that it's you. It's kind of all kind of a bit of an algorithm that then it's essentially goes, you know, Ryan spent money buying Lucozades in Tesco this morning. Let Sainsbury's advertise their Lucozades to Ryan. Obviously they don't know that you bought Lucozades, but they do know that you spent money in Tesco. So it's kind of really, really interesting. And I think what it is doing is kind of combating this idea that, you know, Facebook, Google and any other big company like that, they are essentially making money from our attention because like brands pay them money to spend big money with them. And to reach as many people as they possibly can with their advertising. So, instead of like us, when we get zero for that. We get nothing in our bank account for that attention. We just
scroll past it.
Exactly. So with Zadosh, obviously, you're then getting paid for the time that you spend on the app, which is really, really
and you
wicked.
can literally get a bit of cash, withdraw it instantly.
Yeah.
So easy bit of cash to make on the side.
It is. Right, let's crack on with the investing side of things then. So we probably should start up top with what on earth is investing? For anyone who doesn't really know what it is, tell us what it is.
So essentially investing is where you're giving up some money today in the hope of, I guess, it growing over time. So then in the end, you're left with more. So if you make some money today, you can either spend it, then it's gone forever. You can save it, which is good, but with inflation, it's hard to really actually build wealth through saving because of low interest rates, high inflation. So the third option is investing, and that is essentially where you're giving up some money today in the hope that over time it then gives you a return and grows. And I guess ultimately, in my opinion, the main point of investing is to one day, hopefully in like a couple of decades time, live off of those investments. So you haven't got to work anymore. You can do what you want. Your investments are paying you every single month, every year, whatever it is. Whether it's like, we're going to talk about stocks, obviously, the stock market, but you've got property investing, crypto investing, even like alternative assets like wine and whiskey and watches. There's loads of ways to invest, but essentially you're giving up some money today to try and earn a return. And then hopefully in the end, you're left with more money.
I love it. And for me, like where I was probably a year ago when I was chatting to me, Mr. Money Jar on the episode, is I was in a situation where I was trying to build an emergency fund because I wanted to do that. And it's quite important to kind of feel like in a good position to invest when you kickstart. But we talked a little bit about how having an emergency fund, which is a little bit of savings, about 6 months worth of expenses set aside. And then once you've got that, then essentially the money that you get from there, you can then put into investments to grow another day, because I think what a lot of people worry about when it comes to investing is like, oh, if I put this money away though, I can't take it out, and what if it massively drops in money and then I'm absolutely screwed, and then that they're really, really worried about that. So I'm in a position right now where I'm thinking like definitely investing is something that I want to be doing, and I'm going to be doing it soon. Why is it so important that me as a 26-year-old starts sooner rather than later?
Well, I was going to say first, so that is one like a massive benefit of an emergency fund is that if your investments did drop, you never need to sell them because you can just go into an emergency fund, get the money you need for whatever happened, and then you can then top it back up. I think a lot of people will start investing without an emergency fund, and then all of a sudden their investments are down, and that's the exact same point when they need a bit of cash for something.
Yeah,
and
it's
then
always bad
it's just
timing.
a bad idea. So definitely get an emergency fund. So really, starting in your 20s, I mean, starting as early as possible is so good, mainly because of compound interest. So essentially, over time, the longer you're invested for, the actually less you need to invest per month, and the more you end up with in the end because of compound interest. So compound interest is very misunderstood. I get a lot of questions about it, but essentially all it is when your interest or your return earns a further return. So obviously, if you're investing for a longer period of time, then that return you earn in year one, when you're 21, say, is then still going to be earning money when you're 50, 60. And that really is the main benefit of starting in your 20s is compound interest, and it will essentially just build your wealth and snowball it. And the thing is as well, you don't need, a big misconception is you don't need thousands of pounds to get started. Literally, most platforms you can start with between like £1 and £100. Set up, open a platform, start investing, and literally even £100 today will be worth thousands of pounds in 30 or 40 years time. And that is the main benefit of starting in your 20s.
I got a note from one of your books that says every £1 we invest today will be worth £17.45 in 30 years time.
Yeah, before inflation, right? That's before inflation, I think. But I said that shows the power of compound interest.
I think that's crazy to kind of think that if you locked away £1 today, that's what it would be worth in 30 years time. I think the battle that 20-somethings have right now is, oh, Ryan, but I want to buy a house. Yeah. Like, what do I do? What do I do? Do I buy a house, or do I put into stocks and shares ISA? Like,
it is hard. And to be honest with you, it sort of does. So it depends on your goals, which is obviously that. Yeah. It also depends, I guess, on your salary and your income. In an ideal world, if you could sort of somehow have separate pots set up. So saving for a house, the best thing to use really is a lifetime ISA.
Yeah.
So if you can essentially save £333 a month into a lifetime ISA, you'll then get $4,000 across the year, which is the maximum. And then if you say have £500 to invest per month, you can then put £333 there and then the rest in a stocks and shares ISA. But I think, to be honest with you, if you do have other more short-term goals, it's not the end of the world to delay investing. But at the same time, as we mentioned, every £1 is going to be worth £17.
Yeah.
So really, even if you can do a few £100s here and there, it will pay off massively over the long term. But I think ideally, if you have different pots, that's probably the best way to go about it.
I actually regret not starting investing sooner from reading your book, because your book is really great about, of course, stop, wait and start investing. But like from reading that, I actually regret, like I did just put it off because I did want to buy a house first. And then I have kind of gone, well, maybe I should have an emergency fund first. But actually, I think if I'd have just put some money towards the house and a little bit in investments at the same time, it wouldn't have to be much, but I'd be starting with something. I wouldn't be starting from nothing right now.
Yeah.
And I think that's the kind of benefit from someone who's looking at it, who's even 26. So if anyone's like younger looking at this, like I just put away like whatever you can a month, like, because also I think the other thing about investing is, and Timmy said the same thing when I was listening back to his episode, that actually like you're probably not going to do the best or understand it fully when you first enter investing.
Like anything.
You're like anything, exactly. You're going to need to learn quite a lot about it, and you're going to need to test the waters a little bit. I know you've had an experience about that at the early stages where you kind of...
I made so many mistakes.
Yeah, exactly. You're going to make mistakes, and it's better to do that with like a small amount of money and learn the ropes and not feel too afraid. Because obviously if you do it with like so much money, you're going to get freaked out and you're going to never want to do it again. But if you start off small and then know the kind of like benefits that it can have, or where you should and shouldn't put your money, then that's only going to get better over time.
Yeah, there's a lot of benefits of starting small, because essentially you get used to the stock market, because it is very volatile. You get used to it being volatile. You can build a good habit by doing it frequently.
Yeah.
You sort of, I guess, dipping your toe in. And if you do lose money and you only have £100 invested, you might lose £10 rather than having 10 grand invested and losing the grand. So starting small is definitely underrated. Of course, if you can invest, £1,000 per month, obviously you're going to grow your wealth a lot quicker than someone that can only invest £50 per month. But if you only have a small amount, it's still good to get started, because what we talked about with compound interest, and also the benefits of like getting used to the stock market, building a good habit, all of that sort of stuff.
Yeah, definitely. For anyone who's kind of battling with themselves and saying, but like, I want to be rich now. I don't want to be a rich millionaire at 65.
Yeah.
Like I want to be a rich 25, 26, 27-year-old. Like what's your mindset when it comes to that? Because I think you have a great mindset about that. So
the thing is, I would definitely rather be a millionaire when I'm 65 than essentially still, I guess, having no wealth, still working. I'd much rather be retired at 65, able to pay for like my children's and grandchildren's stuff and all that, rather than still struggling to get by. So that's the first thing I'd say. But I think it is like obviously in the book I call it like the paradox, where essentially everyone wants to be rich. It's quite easy to build wealth over the long term, which is to invest consistently. But obviously everyone wants to be rich now when they're younger. Yeah. So I think, it sounds stupid to say, but the most obvious thing to do is increase your income. Like for anyone listening, imagine if your salary just doubled now. If you found a way to double it, whether that's through like a side hustle, through other income streams, through getting a different job, through getting a second job, whatever it is, then how much more you could invest, and also how much more you could use that money to, I guess, like do fun stuff, go traveling, go on holiday, whatever it is. So I think, you essentially just try and increase your income, then you can both, I guess, build wealth quicker and also do more fun stuff whilst you're young. But I think, that whole, like, I don't want to be rich from 65 mindset, I see a lot on TikTok, especially, where there's a lot of like young kids on there and stuff, like teenagers. But I would much rather be wealthy when I'm older through investing today, even if it's a few £100 per month, than still being in my 50s and 60s, having to work a 9-to-5 job, commuting on the train, struggling to get by, living paycheck to paycheck, all of that stuff.
Yeah, I think that's the idea, is that like it's kind of a battle, isn't it? Because you've got like the YOLO, like you only live once, like, just enjoy it, go traveling, live your life, have like all of this kind of stuff. But then there's the other side of the platform, which is like, you should invest, you should do this, you should do this.
The thing is that you can
like,
do both. And
exactly,
like, a lot of people have this misconception that like investing and having fun, you can't do together, but you can and you should. Like, as we were sort of saying with the house stuff, you almost want to set up different pots out of your paycheck to like save for a house, invest, go on, have a like traveling fund, do some fun stuff, go on a night out, go out for some meals, whatever it is. So I think you essentially, it's everyone's can be a bit different, and it does depend on balance. But you really, if you only invested 100% of your paycheck, you would just be miserable because you wouldn't be doing it. You should be at home all day, not going out, not doing anything, not going on holidays. So you need to find that balance. Everyone's balance is different, but you can do obviously all of those things at once.
Absolutely. So tell us a little bit more about why putting our money in a savings account right now is not the most sensible thing to do for people who are big savers.
Yeah, I mean, savings accounts are just so dead, pretty much. That's the short answer of it. So inflation, which is the general increase in prices over time, I think last month it was 3.1%. So just say 3%. So essentially, if you're using a savings account, and I mean that savings account will definitely be giving you less than 3%, then you're actually losing money per year in real terms. So over time, prices go up, and essentially every pound you save, you can buy less and less of it over time. So the main reason saving thing is, it is good. It's much better to obviously save some money. It is a skill, to be fair, and it's a skill a lot of people struggle with because we need to save for like a house, a car, a wedding. So being able to save is good. But at the same point in time, in my opinion, once you have an emergency fund, unless you have specific goals like a house, like a traveling pot, whatever it is, there's not really much point in saving just because interest rates are so low and inflation is so high. I mean, if you look at sort of the last like 12 to 18 months, I mean, obviously because of everything that happened, savings accounts are literally earning peanuts. Cash ISAs are earning peanuts. A lifetime ISA is a good way to save. You get 25% bonus from the government. But regular savings...
But you can only really use that on a house, or on retirement as well.
Well, I guess like any way to save is pretty much dead. And you're losing money in real terms because of inflation. But if you look at investing over the last 12 to 18 months, I mean, the stock market's at like all-time highs. So by saving, the big opportunity cost is that you're missing out on investing and actually growing your money. So yeah, saving is good, but really, unless you're doing it for a specific goal, there's not a huge amount of point just because interest rates are so low and inflation's so high.
So how on earth do you like make money from investing? For anyone who's listening right now, like what kind of returns can you expect on your investments?
Yeah, so there's two ways: capital appreciation and dividends. And this also sort of applies to like property, like you get a capital house appreciation or rental income. So in the stock market, you have appreciation, which is essentially just when whatever you're investing into goes up over time. So if you invest into something with £100 and then next year it's worth £110, you've then got some capital appreciation, you've made a gain. And that's probably the most obvious way to make money from investing. Like everyone looks on their app, it's gone up in price. Okay, I've made money. It's as simple as that. But there's a second way, which is dividends. And this once again depends what you're investing into. We're going to talk about index funds, but if you're investing into an index fund, which invests into hundreds, if not thousands of companies, that index fund probably will pay a dividend. You can find out quite easily. It's probably somewhere between 1% and 3%, which doesn't sound like a lot, but it's essentially free cash that you're getting every single year. And if you can then reinvest that cash over time, it will essentially compound your wealth, grow your wealth quicker. But yeah, appreciation and dividends are the two main ways. And then dividends do really add up over time once you start reinvesting them.
And like how much can, like in terms of like percentages and stuff like that, like what's the kind of average? Because obviously the stock market, it changes all the time, doesn't it? But like what are like the averages you can kind of expect? Yeah,
it's just like such a common question I see where I get questions like, what returns can I expect over the next few years? And I'm just like, I have no idea.
No one knows
what you're going to get. If they say they know, then they're lying. Economists can't predict it. No one can predict what return you're going to get from year to year because it is so volatile. But over the long term, with like 100 plus years of data, you generally get around 10% per year. So if you take into account inflation, you're probably over the long term going to get 7 to 8% per year through investing in the stock market using index funds. Now, a lot of people, it doesn't sound amazing. You know, people invest into crypto, making like 100% overnight and all that sort of stuff. But I think with investing in the stock market and index funds, it really is just about the sort of long-term, slow wealth building game. And also compounding your wealth consistently at a sort of like high single digit, 7-8%, that will literally make you a millionaire over the long term pretty comfortably. So
I've heard that like if you have 100 grand invested by the age of 35, then in 30 years time, when you're 65, you would be a millionaire. Is that right?
Without investing another penny,
without putting in another penny after 35. That's mad.
It's mentalism. That's
why does no one know that? And why don't they teach that in school?
They should teach it in school. But that's compound interest. If you can, and that's the biggest thing. So with compound interest as well, in the early years, even the first sort of like decade when you're going up to 35, it really is about us just contributing as much as we can. But then once we have that like base of 100K, for example, which is a lot of money, after that, compound interest sort of essentially starts to take over, and that'll then deliver us most of our return. But yeah, I mean, we should be taught like taxes, mortgages, compound interest, investing, all in schools. Obviously, we're not.
I mean, I don't know if I've been interested like in school, and we definitely did interest in compound interest, but we never really related it to money that much or anything like that. Like, it was maths and that was it. It didn't really feel like a real world situation. But I think what's important to remember is that like 7% is like the average over the past 100 years, but some years could be like 25%, but some years could be like minus 10%, for example. So it's not that it's going to be, in next year, you can guarantee that 7%. You don't know basically, but over time, that's essentially what's going to happen.
So you very actually rarely will get 7%. It's more like, as you say, might be, I think like the last year, it's been like a huge percentage, like sometimes it's negative when there's a crash, which is why I think the most important thing to do is called dollar cost average, which is essentially where you or pound cost average, and essentially where you invest at set intervals, preferably per month, on the exact same day per month, every single month. And then if the market goes up or down, it's almost like who cares? If the market goes up, it's great. You're making money, your net worth's increasing. If the market goes down, then it's actually probably better if you're younger. Like, I actually wish the market would crash by like 50% because I could just buy my index funds so cheap, and then I know over the long term it's going to like just blow up my wealth massively. So I think if you invest monthly, then it's almost just best to, as I sort of say in the book and stuff, just ignore the noise. Don't concern yourself with the stock market. You've got an automatic payment set up into an index fund, which we'll get into. That's all you need to do. And if it goes up, you make money. If it goes down, perfect, because you can buy at cheaper prices.
Yeah, definitely. So tell us what the stock market is in greater detail. Like how is it made up? How does it work? For someone just looking into it.
So the stock market, essentially, so obviously around the world, you have thousands of companies. They've all got like employees. They've all got offices. They make products. They make services, whatever it is. They're all essentially, a lot, obviously, most of them are trying to make some money. The idea is, if they're a successful company, they will then IPO and essentially go public, which then means they're essentially listed on a stock exchange, and then we can then buy their stock. So, like Tesla, Apple, Facebook, they're all like listed companies in the US. We have companies listed in the UK, like HSBC, Unilever. So there's loads of companies listed around the world. And essentially, I think it's important when it comes to the stock market to realize that when you are investing into, whether it's an individual stock or an index fund, even though you're seeing it on your phone and it's just like numbers and whatever, there are real people working there. They're making real products. They're trying to make money. They're trying to get by. They're trying to survive, trying to grow, trying to make profit, whatever it is. And then, so I guess that's how the stock market is essentially made up. And then how it sort of works is you can then group those companies together into funds. And obviously that's where index funds come into play.
You talk a lot about kind of like the difference between kind of passive versus active investing as well, because I think there's a big difference between the two. Like what's your preference? Like what would you?
So my preference by a mile is passive investing.
Yeah.
So essentially active investing is where you are, I guess, actively trying to pick stocks to beat the market. So beating the market is usually considered the S&P 500, which is the largest 500 US companies. If the S&P 500 returned 10% over the last year and you got 12%, then you have beaten the market successfully. The problem is, over the long term, it is pretty much impossible to consistently beat the market, whether that's you yourself actively picking stocks or giving your money to an active fund manager and the fund manager picking those stocks for you. It's pretty much impossible to do it consistently. There's loads of data from loads of different sources going back literally decades and decades. That is essentially active investing is very, very difficult to beat the market. And if you do want to try, it takes like a lot of research.
And a lot of time and energy. A lot of time, you're literally probably looking at it all the time. You need to be up to date. You need to be the first one on stuff. And like, that's a whole job in itself, in my opinion. It's
literally like a whole second job pretty much. Which if it interests you, fair enough. But I much prefer passive investing, which essentially is where you use an index fund and then you passively track the market. So rather than trying to actively pick stocks to beat the market, I just track the market, and over the long term, I will get the return of the market, which, as we say, is about 7-8% after inflation. So I'm a much prefer passive investing, but like the data overwhelmingly sort of shows that over sort of like a 10-15 year period, it's pretty much impossible to beat the market. And we're in our 20s, can be investing for 30, 40, 50 years. It's honestly just like
I think a lot of people think that's what investing is, though. That you've got to be like on it. You've got to be at the right time. Like I don't think they realise that there is this kind of very passive way that you can do it, where you literally just set yourself up and you're literally just putting in monthly or however you want to do it, and it kind of works without you putting in too much effort. Like I think you describe it as like you can work for 10 minutes a year, like,
Yeah.
because you only go in and check it or change it or add in a bit of a bonus or whatever, like for 10 minutes in 1 year, like
But
that's
that's
mad.
a great point, actually. I think people have a misconception that like invested is like almost like a second job.
Yeah.
And like it does take some upfront work. So obviously it actually takes 10 minutes to start investing. You go onto an account, you open up a stocks and shares ISA, for example, set up an automatic investment, and that's all you need to do. And as you say, each year, I literally rarely check my investments, to be honest with you. I know my investments are going through monthly, and that's all I need to do.
I think the biggest bit of work is the bit that I'm in right now, which is learning and educating, researching, deciding where I'm going to do it. This is the biggest bit of work that I'm going to do. Once I'm decided and I'm paying a monthly and it's automated, which we're also going to talk about, then essentially it is 10 minutes of work for potentially like wealth in the future.
And as you say, it's a bit misconception. People think you need to be like checking it daily, checking it weekly.
I think that's genuinely one of the reasons that like put me off, like, oh no, it's just too much work. I can't even process that right now. Whereas actually it's really, really not.
Really easy, yeah.
Talk to me about the difference between index funds and ETFs.
Yeah.
Because I think they're words that get chucked around, jargon and stuff like that, and people just go, I'm out. Too complicated.
Yeah. So it's, to be honest with you, for all intents and purposes, they're very similar and they're pretty much the same. But as we mentioned, the stock market is made up of companies. You can group them into funds, and you can then essentially get sort of like traditional index funds or index ETFs. So the differences are an index fund is only valued once a day, and it's usually at the end of the day, whereas ETFs, they essentially trade like a stock. So when the market is open from like 9 till 4 during the day, then if you look at an ETF, you'll see its price sort of fluctuating. So it's just like essentially ETFs bridge the gap between individual stocks and index funds. So index funds are sort of a passive way to invest. They're valued once a day. All the investments are executed at one trading point. Stocks obviously are fluctuating the whole day. ETFs essentially a bit of both, where it's almost like an index fund, but they also sort of trade like a stock during the day. So that's the main difference really. That ETFs trade like a stock, so you can buy and sell instantly. You can like day trade ETFs, whereas index funds you can't, because they're valued once a day at the end of the day, and then all trades normally take place at sort of like one time per day. But so I prefer index funds to like normal index funds personally. That's what I use in my stocks and shares ISA. But ETFs are quite good in the sense that they often require lower minimums to get invested. You can often get started on some platforms, some zero commission brokers, and start with like a few pounds and put it in an ETF. Whereas index funds sometimes require more upfront money. ETFs are also generally a bit more accessible. They're on more platforms, so it's easier to sort of start investing with ETFs. Whereas index funds are more on the sort of like the more older school traditional platforms like Vanguard, Hargreaves Lansdown, AJ Bell. But yeah, I guess if all you're going to be doing is buying once a month consistently, holding for the long term, whether you use for example, a S&P 500 index fund or an S&P 500 ETF, they're going to do the exact same thing. They're both going to track the S&P 500. It just, I guess, depends on what platform you're using and what options are available. But if you're just going to be buying, holding, then literally there's going to be no difference between an index fund and an ETF.
And that's really helpful. I think that really breaks down like the difference between the two, and also that like, you know, that either can be beneficial depending on like what your situation is. So if you're paying in smaller amounts or wanting to invest little amounts, then you know, obviously the ETF.
So I use Vanguard for my stocks and shares ISA, and you need £100 a month minimum investment. But obviously some people don't have that. So you open an account with Free Trade or Trading 212, some of the zero commission brokers, you can literally start with like £5 and then start investing in an ETF. So it sort of like bridges, I guess it sort of helps out because you need less money to get started and they're available on more platforms.
Absolutely. Talk to me about the difference between income versus accumulation funds.
Yeah, great question. So income, as we mentioned, dividends are one way to make money. With income funds, they pay out all the dividends as cash. So you'll receive the cash. So you've got an index fund, so it's got a 2% dividend that it pays annually. If you're in an income version of that fund, you will then receive 2% in your essentially investment account in cash. Accumulation funds, which I prefer, and I think if you're investing for the long term, it's better to use an accumulation fund. They reinvest the dividends automatically. So once again, it makes it passive, hands off, automated. You're in an accumulation fund. It's going to pay out a dividend quarterly, yearly, whatever it is. And all of that dividends is then going to get reinvested back into the fund and essentially just help grow and snowball your wealth quicker. How it will work is you'll get that dividend, you'll then buy yourself more units of the fund. And then essentially because you have more units of the fund, you'll then get a higher dividend next year. Then you reinvest them again. And then sort of over time, and as you're then contributing monthly as well, it sort of all sort of builds up and snowballs. But yeah, I'd say income funds are good because, you know, in 30 years time, when I want to live off of my investments, I can switch to an income fund and then get the dividends and live off of the dividends.
Yeah.
But right now, when we're trying to build our wealth, it's better to use accumulation funds because all the dividends get reinvested. And as we said, we can grow and snowball, we can compound and snowball our wealth quicker over time.
Talk to me a little bit about kind of like putting in like a big lump sum at the beginning or kind of spreading that cost out over like a longer period of time. Like, what is the difference in doing that? Because I think a lot of people think that you need to have like 10 grand up front or £1,000 up front to like get started. Like, what's the benefits of doing either of the two options?
Yeah, so there's obviously two ways to sort of invest. You can either lump sum invest, as you mentioned. If you had 10 grand, you could put 10 grand in right now, or you could, as you say, drip feed it in, dollar cost average over time, and do like £1,000 for 10 months or £500 for 20 months. This is one of like the golden questions of investing because everyone wants to know, like, should I put it all in now or should I spread out over time? And the answer is, it's not ideal, but no one knows what's going to happen. So you just got to do what's more comfortable for you, essentially.
Yeah.
So, I mean, it is tough. I mean, if it was me and I'd like a big 5-figure sum, I would personally probably drip feed it in over time.
Right, okay.
But if I say in, I don't know, 10 years time, have like a £500,000 portfolio, if I then get 10 grand, I'll then probably just chuck it in all in one go. Yeah. So I think it depends on your sort of current situation. Do you think it depends
then on what that 10 grand means to you?
I think so, yeah.
Yeah, so like if 10 grand means like a lot, that means a house deposit or it means other things like that, then you probably would drip feed it in because you've got that bit of like wiggle room to make a different decision.
You essentially need to do what you're more comfortable with. But, so looking at like the data and stuff, lump sum investing performs better 2/3 of the time. Which, because obviously if you look at the stock market over time, it goes up.
Yeah.
So it makes sense that if you invest it all today in one lump sum, you're going to be better off. But even though financially you could be better off, I think like psychologically, if a lot of people invested 10 grand and then the stock market crashed tomorrow, because no one knows when it's going to crash. If it crashed on Monday, 30%.
You'd cry. You'd be like, oh my gosh. Yeah.
They'd be so scared. And I think one of the biggest risks of investing is when essentially investors get scared of the stock market and then think it's a scam because they've lost a lot of money in a sort of short time period, and then they just neglect it for the rest of their lives. Whereas it all comes back to like financial education, but like if you sort of understand what it is, crashes and corrections happen very often.
Yeah,
it will over time.
Because from a crash, like usually it goes up like way beyond where it was before. Yeah. Like if you look at the stock market, it usually then like so actually it recovers. Yeah. You know, even better than the situation it was before.
Like, if you're using like a US fund, or I use global funds personally, the stock market always recovers. Obviously, when it has crashed, it doesn't feel great. You know, you're a bit nervous and all that, but you sort of need to sort of come back and realize this happens, this is common. But I think when it comes to like lump summing a big sum of money, a big danger is lump summing it, losing a lot very quickly, getting scared of investing, thinking it's a scam, and then essentially missing out on the next 30 years of gains and dividends because, I
think that's the benefit of like starting off small, then starting off gradual, putting in per month, learning it as you like do it. Like learning, everyone knows it from learning on the job, that's the best way to learn, right?
I completely agree.
But like, so do it kind of in the ways that you feel comfortable, like whatever you feel you can put away per month. And then like, as you say, I think you say like when you get a bonus or a birthday or whatever like that, you add that in because now you're in a situation where you feel comfortable doing that because you understand everything that's happening. But like for someone who's just dipping their toe in, like I'm not going to start with a lump sum. I'm definitely not. I'm going to start with whatever I need to open my account and then monthly amounts and stuff like that.
That's what I did as well. That's what I did a few years ago when I started.
And that's where I think I'm going to start because I think for me, like I want to watch and see how that kind of works out. Am I in the right place? Make sure I'm happy with what I've got. And then from then build my confidence in it. And I think that's probably a really, really important.
And as we mentioned, that's another benefit of starting small. Like, it's actually, if you have a lot of money, you can build your wealth quicker. But starting with £100, even though it's not going to make you a millionaire overnight, it's underrated because you'll like dip your toe in, as we say, and you're sort of working out as you start. And hopefully, by the time you have like a grand or something in, you then sort of know what you're doing, what your plan is, what your strategy is. You know about corrections and crashes, and they're normal. And you're just like a lot, I guess. You have that financial education. You're grounded. So you sort of know what's going on.
I think that's really beneficial. We talk a little bit about in Timmy's episode about the difference between pensions and like stocks and shares, ISA.
Yeah.
But for you, like, what is the difference? Like,
So the big difference is with a pension, the money goes into your pension out of your gross pay.
Yeah.
Whereas with an ISA, it goes in out of your net pay. So essentially, if you think like we work, right? You work, you make some money, you then normally pay tax, national insurance, student loan, any other taxable benefits. You then get your net pay And then essentially from your net pay, that is then what you contribute to your ISA. So with an ISA, you essentially don't pay any tax on any gains because you've paid income tax and taxes today. So you essentially pay tax today, and then all the gains are tax-free, all the dividends are tax-free, all the bond interest is tax-free. A pension is literally the exact opposite. So it comes out of your gross pay, the top line. And obviously if you have like an employer who gives you like a employer match, that's what I get. I get a 6% employer match. That's literally
That's
free,
really good.
literally free money.
Normally employers usually do like a little bit less.
I think 3% is the minimum.
Yeah, it's normal, yeah.
So 6% is literally free money.
Yeah.
Like that comes out of my gross pay and I go straight into my pension. My employer then match it. But then the downside of pensions is you then have to pay tax in the future.
Yeah.
So I think it's increasing to 57 in a few years. But essentially, when I come to 57, 25% is lump sum, but then 25% is tax free, but the rest of it I then have to pay tax on. So you avoid tax today and then you pay tax later. And then ISA is completely different. You pay tax today and then avoid tax later. The thing with pensions is they are great. If you can get an employer match, it's literally a no-brainer. So I contribute 6%, they contribute 6%, 12% per month going into my pension. It's a no-brainer. The downside is that no one knows what the pension rules or the tax rates are going to be. Like I'm 24, I can't access that for 33 years. I have no idea what the pension rules are going to be, what the tax rates are going to be. Whereas with an ISA, there's more certainty because I paid like 20% income tax today, 12% national insurance, 9% student loan. So then I then know, like I pay tax today and then I know all of that money is then going to grow tax-free over time. Another benefit of ISAs, and this is sort of the other big thing, is flexibility. So with pensions, you can't access them until retirement age.
Yeah.
Whereas with ISAs, they're a lot more flexible. You obviously don't get that employer match, so it's not maybe you don't have as much money compounding, but they're a lot more flexible because if I build up my ISA to, if I build up my pension and my ISA both to £1 million by the time I'm 30, I can't access my pension for another 20, 30 years. Whereas my ISA, I could start living off of the dividends and the gains right there and then without paying any tax. So yeah, I think they're both good accounts. And if you are working like a 9 to 5 and have an employer match, definitely take advantage of the employer match. But I think ISAs probably are better just because of the flexibility they give. If you are younger and you're like teenager, you're in your 20s, you have aspirations to retire, early in your 40s, like 10 to 15 years before retirement age, then using an ISA gives you the flexibility to actually live off of your investments. But yeah, sort of. But then if you're older, say if you're maybe in your 40s and you just start investing and you know you're going to be working until retirement age, then it actually probably makes sense to use your pension more and get that employer match and avoid that income tax because you know you're not going to need that money until you actually retire. So yeah, depends on your sort of goals. But being in your 20s,
all of this is literally dependent on like where you are at. I think everyone listen to this. This is why it's so important to listen to this, but then also go away and educate yourself to understand what is right for you in this situation. Is one of your aspirations to buy a house in however many years' time? Is one of your aspirations to be, or are you just interested in kind of growing wealth over time and you've kind of got a bit of cash spare, or are you, cash strapped at the moment and can only put a little bit away? And then then your situation and what you're going to do with your investments is going to differ in every single scenario. So I think it's really important to kind of go away and do your learning.
Because what I normally say to people who are in their 20s, obviously Talk 20s, and the approach that I personally follow is that I'll max out my employer match, I'll put 6%, and then after that, I then go straight to my stocks and shares ISA because I have goals of retiring or being able to retire before retirement age. So I want to max out my ISA as much as possible to live off of that before retirement age. So that's the approach that I personally follow. And then I haven't yet, but hopefully one day I'll max out my 20k ISA. And then after that, that's then when I'd go back to my pension. But yeah, after the employer match for me, employer match and then ISA, that's sort of the way I go about it.
Yeah, because you can only do 20k a year in
an ISA.
In stocks and shares ISA. Yeah. So with the funds that you invest in as well, going back to like the practical approach that you kind of use to invest in, talk to us about the difference between a global fund and a US fund, because I hear a lot of people going, I invest in the US stock market.
Yeah.
But you invest in the global, right?
Global, yeah.
So yeah, like what is the difference between the two, and like what's your reasoning for investing globally rather than just in the US fund?
So the fundamental difference is with a US fund, so for example, the S&P 500 or the total US stock market, you're only investing into US companies. Now, I know that obviously the world's very globalized, so a lot of US companies do make money from around the world, but They're still listed in America. They're still obviously dependent on the dollar, which as we know is obviously losing its value like most other currencies. So even though they do make their money from overseas, they're still US listed, US companies pegged to the dollar, like all of that sort of stuff. A global fund then essentially just invests in the US, but also all around the world. So, and with global funds, you are still very heavily invested in the US. So the US is the biggest stock market by a mile. In a global fund, the US makes up about 57, 58%. So even using the global fund, your returns will still be heavily dependent on the US. But it just comes back to, so for me, I essentially accept that I can't beat the market, which is why I passively invest using index funds. The second thing I then essentially concede is that I don't know which country is going to perform the best, which is why I use global funds. So obviously I go through it quite a lot in the book, but over time, like we're going to be investing for 50, 60 years. No one knows which country is going to perform best over that time. So the US has been doing really well the last sort of 10, 15 years. But in the noughties, the US stock market did not do as well as the global stock market. There's also if we look back to the 80s and 90s, Japan, right, was the biggest stock market in the world. It made up 45% of the global stock market. Now it makes up only 8%, and they're nowhere near as dominant as they were 40 years ago. You know, because you imagine if you put all your money in a US fund today, and in 40 years' time, China's making up 50%, and the US is then 10%. I mean, it probably, thinking about it now, it does seem unlikely because the US is so big, so dominant. A lot of the most innovative, like Tesla, Apple, Facebook, Amazon, all there. But it always comes back to, it's impossible to know what's going to happen in the stock market. No one knows what's going to happen. No one knows which company.
Do you feel like you're covering all bases with that?
Essentially, yeah. So with the things with a global fund, you're never going to be the best performer, but you're also never going to be the worst performer because you're essentially investing. You know, you have, and I guess the main benefit of a global fund is you are essentially investing around the world in proportion to which each country makes up of the stock market. So to put that more simply, the US makes up 57% of the stock market. So in a global fund, there is 57% US stocks. The UK makes up 4% of the global stock market. So in a global fund, the UK has 4% worth of the UK of stocks in the global fund. So essentially almost like a global fund's efficient in how it distributes its money into the different areas of the world. And then over time, if say China did start making a lot more of the money and the US started weakening, then that then essentially over time be reflected in the US fund and in the global fund, sorry. And if you only had a US fund, then obviously you would have lost out because other countries are doing better. So it's one of the things where obviously my approach is very much just be as diversified as possible and make it automated and passive and hands off. I could use a US fund, but I'd much rather have a global fund. I'm globally diversified. I've got the US, I've got Europe, China, all the emerging markets, everywhere around the world. And then I sort of know over the long term, whichever countries or industries or individual companies do good or bad, I literally don't care because I'm investing in all of them already. Like a global fund will have probably so the one I invest into has got 7,000 stocks in. They usually have between about 3,000 and 10,000 stocks. So you're so diversified that whatever happens, you'll literally be fine. And another interesting fact is 1% of 99% of stock market gains come from 1% of companies.
Wow.
So by essentially investing globally, I'm definitely going to be investing in those 1% companies, and they will deliver like most of my return over the long term. But yeah, so I prefer global funds. I mean, another example, the UK used to, 100 years ago, when it was the dominant sort of superpower, made up 25% of the global stock market. Now it only makes up 4%. Like, I know we're not going to be investing for 100 years, but we're probably going to be investing for, for 20, like 40, 50, 60 years. The global economy can completely change, which is why, I don't want to bet on an individual country. I'd rather just be globally diversified. And then as the sort of global stock market ebbs and flows over time, whether the US does well, China, Japan, the UK, I don't care because I'm investing in all of them and I'll be fine whatever happens.
Your book, you talk about this a lot in your book, Stop Waiting, Start Investing, which I'm about halfway through at the moment, which is why I can have this conversation quite confidently with you. But I think it's brilliant what you've written there, and it literally breaks things down so easily. Tell us where people can get that book first. It's an ebook, isn't it?
It's an ebook, yeah. Best way is probably go to my Instagram and click the link in my bio. Yeah. And it's the first link there.
Making money simple.
Making money simple, yeah.
Yeah, amazing. Just to recap then, you talk a lot about your 3-step method in that book, which you'll go, obviously, if anyone purchases it, we'll go into much greater detail. Yeah. But just to recap kind of a lot of what we've gone through. Tell us about your 3-step method.
So this is the 3-step blueprint to start investing. And investing genuinely is very easy. Obviously, it's good to do your research before, but it takes like 10 minutes to set up. It's very easy to get going. And then with investing in the stock market, it's not like a mortgage. You're not locked in for 30 years. You can change your index fund. You can change your platform. You can change your account. So just get started. That's the best way to go about it. But the 3 steps, the first one is you need an account. You need an investment platform. The second one is you need an investment account. And then the third one is you need an actual investment. So me personally, my main account is my stocks and shares ISA. So step number 1, the platform, I use Vanguard. Step number 2, the account, is a stocks and shares ISA. And then step number 3, I use a global index fund called the FTSE Global All Cap. And that is essentially my 3-step approach. It took me 10 minutes to set up in 2018, I think it was. I'm still doing the exact same thing today. All I have done is, as you sort of mentioned, over time, as my salary's gone up, I've slowly sort of increased my amount I'm investing per month. But yeah, so I guess like there is like an analogy where, so essentially, those 3 steps, right? So choosing an investment platform is like choosing which supermarket you want to go to. So you could go to Tesco's, you could go to Asda, you could do one or the other, you could do both. Yeah. Step number 2 is choosing an account, the stocks and shares ISA. So that's like, I guess, choosing between like a bag for life or a 5p plastic bag. Yeah. And then step number 3 is the actual investment that goes inside of the account, inside of the platform. And that's almost like doing your shopping, picking out the things you want. You're putting it in your bag in Tesco's, and that's essentially the 3-step process. So genuinely it takes 10 minutes to get started. And then, as you said, per year, it's 10 minutes worth of work. If you get a bonus, invest it. Yeah. Your salary increase your monthly investments. But yeah, I guess my sort of whole thing and what I sort of go through in the book is I'm trying to almost teach the sort of like simple, stress-free, hands-off, passive, automated approach to build your wealth over time. You can be like researching stocks, trying to pick stocks, but I personally, I'm not interested in that. I'd much rather just set up an automatic payment into a monthly into a global fund, and then spend the rest of my time like working the job,
enjoying life,
making money simple, having fun.
Yeah, exactly that. Love it. We're going to chat very quickly about life in your 20s as well. Is it 24 at the moment?
24, yeah.
Yeah. So you've been investing for 3 years?
So technically 4 years, because on placement year I had a auto-enrolled workplace pension. Right, yeah. I've sort of been doing it like properly myself for 3 years.
Yeah. So one of the things we always ask our guests to come on the podcast is if they've had a very big adulting fail or disaster that they feel like, obviously you sound like you've got like your shit sorted out with your investing side of things, but like all of us have massive disasters in other areas of our life. Is there any one that you remember in particular?
So I actually did have a financial disaster before I started investing, which I do remember. So essentially, I think I've actually told this before in Clubhouse, but essentially I ended up buying Yeezys from eBay that were fake.
Oh no.
For £400.
No. Oh my God.
So it was fine in the end, right? It was fine. I actually got my money back in the end. But literally, because I've been researching them for months. This was like back in the day as well, where I think Kanye West had like just joined Adidas. It was only like the Turtle Doves, the Pirate Blacks. It was only like, I think 4. Yeah. So I got the, I think it was the Turtle Dove ones. But yeah, I'd researched them for months. I knew all like the tells, like, so I was looking at photos. I knew which ones are fake and stuff. This listing on eBay had real photos.
But they sent you fake ones.
They sent me fake ones.
No.
And paying 400 quid for trainers. It's absolutely stupid.
Oh
but
God.
This is like when I was like, this is like, I think literally just before I started investing. So that was like a big mistake. And then there was a big thing, like my mum wasn't happy. I had these fake trainers, had to like try and go through like the eBay like tribunal to try and get my money back. Got it back in the end, but it was a bit of a disaster. I was like, all right, I'm not spent. Luckily since then, I never spent that amount on trainers, and I never will.
Yeah. Oh God, that's funny though. I mean, I think we all do it though. Like you want the latest thing that's come out. Like we've all tried and like hoped and wished and prayed and stuff like that. And you probably thought you were getting a cracking deal.
Yeah, I thought 400 quid. There's some listings going for like £600. Yeah. 400 quid. Been saving up for months. These were real ones. No, fake ones.
No. Is there anything that kind of holds like you back at all, and like in terms of something that you're trying to work on, like doing better at? Because obviously, what we chat about a lot on the podcast is that none of us have like life figured out. Like we're all working and we're all trying to get better at something. What is that something for you at the minute?
Everyone's definitely winging it. Literally,
yeah, 100%, 100%.
So something I want to improve at, to be honest with you, is like public speaking, which is why I'm quite glad here. To be fair, because this is the first in-person podcast that I've done. So I'm glad that I'm
you're
here.
doing a good job.
But I've had like, I get like quite a lot of emails and stuff. And I've had like quite a few chances to sort of do like an in-person talking event, or like talking to an audience about like investing money, and I haven't yet, but I'm hoping maybe in like 2022. I guess because of like lockdown and stuff, maybe not as many were going.
Stop waiting, start speaking.
That's your book.
That's my book. Yours is stop waiting, start investing. Mine is stop waiting, start speaking.
That's good. But yeah, public speaking is something I want to start doing, because I've sort of been bottling it so far, but I need to actually do an event and like talk in front of people.
Yeah.
It's good to talk in front of like you here, but this is the first time I've done like an in-person.
Brian, you should do that. Like you need to stop holding yourself back from
start
that.
Start speaking.
Yeah, exactly.
And once I've done a speaking event, I'll release another book, and that's what I'll call it. Everything I do, just stop waiting, start gymming, stop waiting, start speaking. Whatever it is, I'll just make a book about it.
In terms of like making you feel more confident than your 20s, do you feel like your confidence has grown since from the age of 20? Like, were you a little bit more of like a nervous person and you've kind of grown into confidence? Because I feel like your platform's grown.
Yeah.
You are quite a confident speaker, like here today.
Yeah.
Like,
to be honest with you, like, so yeah, I was I guess I was like fairly shy when I was a teenager. So I didn't actually put my face on my Instagram until I think it was like about this time last year. So actually, I think it was this year actually. I think like the first 2 years of having Making Money Simple,
it was just like anonymous.
Yeah. So I was essentially just like worried about putting my face on it, what people would think. But I think, I'm at the point now where like, it's one of the things where I guess like the less you care, the less it sort of matters. So I think if people sort of found out about it a year ago, I'd have been like, all embarrassed and stuff. But now I'm like, you know what? It's a decent platform. I've got some followers. My face is on it. If people find out, I don't really care. But I think it's just like probably doing the whole Making Money Simple stuff probably has helped me improve my confidence, because like I'm doing like TikToks, which are cringy. I'm doing like YouTube videos. When I watch back, I'm like cringing at myself. Doing like Instagram reels, but like all of that sort of stuff, whilst it's like cringy, it obviously helps your confidence, because like you're putting your face out there, you're sort of recording yourself. It always feels a bit weird, but I guess like it probably has made me, I'm a lot more confident now than 5 years ago.
A lot more people ask me like, how do you feel so confident about, doing videos and stuff like that? And I'm like, the answer is I don't.
Yeah, we don't.
I don't. I feel super cringy.
Yeah,
like
literally.
I did a TikTok, but I've been talking to my friends that I was going to do this like series of TikToks for a while, which is like taking popular culture, like for example, Squid Game has been really big recently, and like talking about like the life lessons that we learn from it, to try and talk like, I'm all about life lessons, I'm all about life skills and stuff. And I keep saying to my friends, I'm going to do this series on TikTok where I talk about life lessons that we learn from like Squid Game or Adele or whatever's popular in that moment in time. And I've started doing, I did my first one, I watched it back, I was like, it's cringe. I was like, it's so cringe. I can't do it. But I know that once I've done my 4th, 5th or 6th, I'll be in the flow. Same with doing this podcast. When I did the first one, I was like, oh my God, that's so cringe.
It's like imposter syndrome, isn't it?
And now I think, well, I just got to get practice. And then my one day down that, I won't feel so cringe. And actually people aren't looking at it and thinking that is cringe. They're thinking, oh yeah, I agree with that.
Like, and I think it's mainly in our heads. People aren't like looking at our videos and like laughing or like going, hey, look at this. Like, but people like what?
But that's what I think they're doing. Yeah, definitely.
But I think like doing the whole like side hustle stuff like podcast, YouTube, definitely helps you sort of build confidence. And hopefully, going back to the last question, hopefully because of all this, I can then do a public speaking at some point next year. But I'd say my confidence is definitely better now than it was before.
So if you had to go back and give your 20-year-old self just one piece of advice, you're obviously going to say start investing, aren't you?
Stop waiting, start investing.
But you did start investing as a 20-something,
Yeah, so
right?
I actually did start when I was 20. Well, I guess technically, because so my workplace pension, I was 20 when I was working in London for that year. But I guess I sort of properly started investing when I was 21, like actively doing it myself, opening up a stocks and shares ISA. Honestly, I would probably just say, I like read more books, to be honest with you. Like, I've only really started reading the last sort of like probably year or two, but every book I read is just normally really good. You learn new things, whether it's about like money or like business or about like self-help. And I think like I used to always hate reading when I was younger. Like even at uni, like they get these like all them textbooks. Like didn't read any of them. Like, didn't
My
like
boyfriend
read
says
them.
this all the time. I mean, like, and he's just read the Little Book of Common Sense Investing.
Best investing book.
Which
other
is
than mine, second best investing book.
Second best investing book. He's just read that and he's like, my mind's blown. Like, and he's like, and he said, I've learned so much from just reading that one book that is going to help me for life, pretty much.
Build wealth over. I'd say reading, honestly.
Yeah,
probably.
I did actually a poll on our Talk 20s Instagram the other day, and I asked people like, how do they like teach themselves like new things in their 20s, like what's the most common way? And a lot of people said books, but the most popular actually was podcasts.
Was it podcasts?
Yeah,
I would've
that
thought
was
it
the
was
most popular was podcast. I feel like podcast and YouTube are kind of in the same boat, but lots of people. And then another one was like really popular was like, I just learn through doing. And I think that's so true. Like, you know, if you're wanting to learn something, just get out there and like stop putting it off. Like, I think that's the main thing to learn from like this whole conversation that we've had is to just get out there and give it a try, dip your toe in, give it a go, because you're only gonna grow. So
I get this question quite a lot on TikTok actually from like teenagers, essentially like what should I do? Like I don't want to go to uni, don't want to do. I'm just on like honestly just read books and watch YouTube videos, find out what you're interested in, and essentially just start like a sort of side hustle or a job following that thing. But yeah, I think reading books is probably something I wish I'd done when I was like a teenager, but at least I'm doing it now, but only the last sort of couple of years. A lot of them are like investing or self-help books, but I'd say start reading books and start investing. That are the 2 tips if you're 20.
So Ryan, where can we find you on social media?
Making money simple. Everywhere.
TikTok,
Instagram, YouTube. Yeah.
Love
you just
it.
Google that. Hopefully all my links will come up.
Yeah,
Making money simple. Essentially upload content, very frequently on social media, so you can find me there. If anyone has any questions, feel free to DM me. I literally reply to pretty much every DM and comment. Even now, it does take me quite a long time. Yeah. Sometimes a couple of hours a day, but I'll still literally get back. It may take up me a week or so, but I'll get back to you. So any questions, DM me. And Making Money Simple is where you can find me.
Yeah. Thank you so much for coming on this podcast. I've loved chatting to you. I feel like I've learned loads. So thank you so much for coming on.
Thank you for having me, Gabby. It's been a pleasure.